Are you overpaying for your rental property without even realizing it? Imagine discovering months after a purchase that you could have saved thousands if you'd bought it a little differently. I spent the last 2 decades analyzing deals, buying properties, and working with top real estate investors to determine exactly what separates the good buys from the great buys. If you don't buy right, you could lose thousands before you even start. And I'm here to help make sure that never happens. So welcome to Strategy Saturday. I'm Charles Carillo, and in this episode, we're discussing the essential strategies for avoiding overpaying for your rental property. How well you purchase a property will determine its profitability, and believe it or not, your profit is determined before the property even closes. So stay tuned, because by the end of this episode, you'll know exactly what to look for to make smarter, more profitable real estate investments. You make your money when you buy is a famous real estate investing phrase that perfectly fits with the topic of this episode. How well you purchase a property will determine the profitability of the deal. In other words, the profit is determined before the property closes, not during the ownership period. When I look back on previous deals that I've done, both okay ones and very good ones, I believe a few things have made the difference between the two. Number one is understanding the market and the submarkets. When I've done this, I've done much better. So for example, the largest MSA, metropolitan statistical area in the United States, is New York, Newark, okay? Still, several submarkets within this MSA can differ widely, including Manhattan, Brooklyn, the Bronx, Newark, etc. So knowing the market's number one, but then also understanding the submarket is also very important. So what makes for a good market or submarket? I would say population growth, income and job growth, employment and job diversity, and landlord friendliness. Number two is we kind of drill down a little bit and you're understanding the specific neighborhoods where you're looking and investing. So looking at the income maps, you can precisely see where the neighborhoods change regarding income. Usually these areas are separated by a highway or a busy street or a train track or some sort of body of water. But understanding the income of an area will allow you to understand the potential a property quickly has. Now, if an area's median income, let's say, is $30,000, and your business plan is to increase rents where they currently are at $800 a month to say $1,200 a month, that will price out the current population since it is more than 1/3 of their income. So even if they did want to pay that, you're probably not going to approve them because we work by that whole strategy of it's only 1/3 of someone's income that they can pay for rent during our underwriting process. So it's not going to work. You'd have to go into an area that is more expensive to do that kind of renovation, or where income is higher, or you'd have to do less renovation. Now, if you're serious about purchasing a property in specific neighborhoods, you or someone trusted on your team needs to actually drive them. And you can utilize technology to find current rents, sale prices, and the status of properties on the market, but you need to know the area. You need to see the area, review the comparables that you are reviewing, because you might just pick out some comparables. But if you plan on renovating units and raising rents to match another property in an area, go to that property, mystery shop it. Okay, it will give you the most accurate idea of what a property requires to achieve those rents in that area, and you can now adjust your underwriting accordingly. The main lesson here is that neighborhoods change usually fast, and the subject property a quarter mile from a comparable you found online might not be accurate comparable for you to use. And additionally, your potential tenants will visit the property before renting it, and they will notice the property in the surrounding area before they even arrive for the tour. And they're going to notice it every day on the way in and out of the property. And maybe you got them for 1 year, but you're probably not going to get them on a renewal if they're paying too much for the area that they're in. And number three is thorough due diligence. And I'm not going to go through the entire due diligence process, but there are a few main areas where I usually see investors kind of cut corners. And the first part is the financial audit. So before you make an offer, you should have reviewed the financials and confirm that you can renovate the property, increase rent, and increase the net operating income. Okay. However, during due diligence, we are now verifying the accuracy of those financials. So do the deposits match up with the bank statements? Do the expenses on the financials match the bills that you provided to you from the seller? And are all the property expenses accounted for? Or are you missing some? Are there any other irregularities? So if you have something and you're seeing that landscaping is this much, that's what it's supposed to be, but you look onto the financial statement from the seller and there's no landscaping mentioned, that's an issue. That's something you're going to have to pay for. Most likely, they are paying cash for it, or they are running it through another property of theirs, and it's not on that property that you're buying's financials. So these are important things because it can screw up what you're paying for a property, the value of the property, because it's actually less. Now, the second is the lease audit. So run each tenant through a state search to see if they've been evicted. How complete is the tenant's application package? If it's very like put together really well, all the information there, I'm going to feel a lot better about it. They did like a thorough underwriting. And how long have the tenants lived there for? Many new leases in like the last 30 to 90 days always make me a little nervous, since the seller might have just rented to anyone to improve the property's financials. And this tends to lead to evictions being much more expensive. I'd rather buy the property with more vacancies than buy a property that's been really stuffed with tenants that really don't match with the correct underwriting that should be done. Now, the third is the physical inspection or the unit walkthrough. And don't be afraid to hire a property inspector and additional contractors to perform the unit walkthrough. If you are a new investor, maybe you pay a contractor to initially tour the property with you before making offer. And minor issues on the service might lead to costly repairs down the road. And it's essential to hire professionals to walk every unit, in addition to reviewing all the major aspects of a property, including the roof, plumbing, the drains, HVAC systems, etc. If there is an issue, the contractor is already there, so they can quote you and what they'll need to fix it. You can then submit this to the owner if you plan on renegotiating the sale price. And if you want to learn more about due diligence, check out episode SS161, and that's SS161, where I really break that down. And this is the whole thing with the physical inspections, which I see people kind of cutting corners on, is that you're going to be buying a property, spending hundreds of thousands, maybe millions of dollars on a property. And, people get cheap when they're not bringing out inspectors. Bring out all the inspectors you can, maybe even 2 for each one, for every type of system. If you don't trust someone's kind of advice that they've given you before or that they're telling you on the phone, maybe you bring someone out as well. It's not going to be wasted. Okay. Especially if you're getting to the point where your money is going to be going hard soon and non-refundable is what I mean. It's important to know what you're buying and to make sure that you're aware of 100% what you're getting yourself into. Hopefully by following these strategies, you can avoid common pitfalls many rental property investors make. And please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.
Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.